Today, we're going to break down everything the numbers are telling us about this company. Over the last 12 months, ServiceNow brought in $13.96 billion in revenue and turned $1.76 billion of that into profit. But honestly, the profit number alone doesn't tell the full story here. The number that really stands out is free cash flow, which is the actual cash the company generated after paying for everything it needs to run and grow. ServiceNow's free cash flow came in at $4.63 billion, with a free cash flow margin of over 33%. That means for every dollar of revenue, the company is pocketing about 33 cents in real cash. That's an exceptionally strong number for any business, let alone one growing at this pace. Speaking of growth, analysts are forecasting that ServiceNow will grow its revenue at roughly 20% per year over the next 3 years, and earnings per share, that's the profit attributed to each individual share of stock, is expected to grow at about the same rate. In the tech world, sustained 20% growth is a big deal, and it signals that the company's products are continuing to win new customers and expand inside existing ones. Now let's address the elephant in the room, that stock price drop. Over the last 52 weeks, ServiceNow shares have fallen by 48.36%. That's a significant decline, and it's important to understand why that matters to investors. When a high-growth tech stock drops this sharply, it often means the market got nervous about valuations, meaning people started questioning whether the stock was priced too expensively for what the company was actually earning. But here's where it gets interesting. The forward price-to-earnings ratio, which compares the stock's current price to what analysts expected to earn in the future, has now come down to 24.46. That's much more reasonable than where it was before. There's also a metric called the PEG ratio, which adjusts the valuation for expected growth. ServiceNow's PEG ratio sits at 0.98, and a number below 1.0 is generally considered a sign that a stock may actually be undervalued relative to its growth potential. The company's financial health looks solid too. ServiceNow has $5.18 billion in cash on its balance sheet against only $2.43 billion in debt, giving it a net cash position of $5.48 billion. In simple terms, if the company paid off every dollar it owes, it would still have billions left over. The Altman Z-score, which is a measure of financial stability, where anything above 3 is considered very safe, comes in at 9.3 for ServiceNow. That's a remarkably clean financial position. Institutional investors, meaning the big mutual funds, pension funds, and hedge funds, own nearly 87% of the shares. That level of professional ownership usually signals a high degree of confidence in the business long term. The average analyst price target sits at $141.86, which would represent a 33.75% increase from current levels, and out of 48 analysts covering the stock, the consensus rating is a strong buy. That said, no investment is without risk. Short interest, the number of investors betting that the stock will fall further, has jumped significantly in recent months, from about 39 million shares to nearly 58 million. That tells us a meaningful portion of the market still has doubts, whether about the economy, competition, or the pace of growth. So where does that leave us? ServiceNow is a highly profitable, cash-generating business with a dominant position in enterprise software and strong growth expectations. The stock has taken a major hit over the past year, which has made it look more reasonably priced than it's been in a while. But like any stock, it comes with real uncertainties. Whether that combination of value and risk makes sense for your own situation is always a decision worth thinking through carefully. If you found this breakdown helpful, make sure to like, subscribe, and hit that notification bell so you never miss our next deep dive. We'll see you in the next one.